Hi, and welcome to Dollars and Making Sense, a weekly show about finance, money, and investing. I'm your host, Ray Treverson. I'm from OTG Capital. We broadcast locally on Radio Northern Beaches and around Australia on the Community Radio Network. We go out on Spotify, YouTube, iHeartRadio, a couple of other things, as well as the community radio networks. So hopefully we are getting to you one way or another. I'm really pleased to welcome back to the microphone this time around Michelle Griffiths from TAG Financial Services. You can't miss that because she's got a background this time around. So she's got a background in the back for the people that are watching this on video streams. Nice to see their bit of shameless plug, but what the heck, that's where a little bit of shameless plug, but mainly education.
Lots of information and education, and hopefully a little bit of inspiration. Right.
That too. So look, ladies and gents, one of the reasons I asked Michelle onto the show to begin with was that we talked about the last time we talked about was superannuation and primarily what it's not used for, because a lot of visitors come onto my show and we talk about what it is for. I'm a huge proponent of super. I think it's probably one of the best and most tax effective investment schemes that we've got. And we're now reached that tipping point, if you're not aware, that over 50% of the nation now doesn't need to draw a pension. And I think that's a really wonderful thing. And those of us that are in the financial services industry, even though my experience tends to suggest that there are many right-leaning Liberal Party coalition voters in the financial services area, none of them are complaining about the $3.5 trillion sitting in super that they are able to go out and service on a daily, weekly, monthly basis. And so I guess there's a backhanded thank you to Paul Keating and the Hawke government back in the 90s.
It was actually a stroke of genius, really. When you look back at those times, it was groundbreaking. It was actually quite ingenious, and I often reflect, Ray, on where the wealth of Australians often lies is in two places. One is in the family home, because the bank essentially forces you to pay off that loan. So there's forced savings in that regard. And then the other one is because of this superannuation system, because once again, there's this forced savings element to it that basically uses the time value of money, and it means that there is actually a nest egg there at the end. So how well you use it is another thing. But one of the things that we're going to talk about a little bit today is understanding some of the power of that concept of forced saving, money saving over time. I think is what we also want to talk about today, is how we can use it beyond the family home and superannuation.
Yeah, and I think it's important to note, ladies and gents, that one of the key factors that when Keating and Hawke first started this was that they traded off 3% of wage increases for 3% in super. And that could only have been possible at the time because of the union movement and Bill Kelty coming on board. So those of you that like being revisionists, please go back and have a read. It's fascinating reading. And I'm not trying to pull a partisan line. I think credit where credit is due. It's an ingenious system, and I think it's the envy of the world when certainly across the Tasman, I have friends that are retiring on KiwiSaver at the moment. It's in no way anywhere near as generous, and I think they're very much on their own. But look, what we're going to be talking about today, Michelle has asked me for us to have a bit of a talk about how you structure your wealth creation systems, I guess, if you are looking to try and retire before you turn 60. Now, I think if those of you out there in the listening audience that are younger probably look on that and go, wow, that's a great dream. I've already passed 60, so I'm just sitting there going, no, I'm actually quite happy to work. So that's all good. Michelle, I'm not going to ask you your age. I'm a gentleman, and gentlemen never ask ladies their age. And I'm not even going to try and guess because I get that wrong every single time. So we're never going to go down there. So look, let's talk about what we are going to focus on today. So in the last show, we talked about what you can't do with super. And one of the big things is early access. So let's focus on that to begin our discussion today. The idea that, you really can't touch anything in super before you're 60 unless there is financial distress. And I think that's always a good thing for people to remember, is that if you are absolutely desperate, the superannuation system can be tapped into for financial hardship reasons, but they've got to be fairly out there for that.
And,
TV
and it's
consider.
fairly limited on how much you can get.
Oh, very.
As well, which and fair enough. I mean, the whole idea of superannuation, it is supposed to be there for longevity. So they don't want people tapping into it too early. So one of the things that we've been finding more and more with, I call it the younger demographic, so 30s and 40s, some 50s. I still call 50s young, by the way, Ray. What we find is that there's a lot of people who they may be targeting towards retirement, but they might be wanting to retire at 55 or 58 or whatever the number is. And these are good things that, I mean, we have a lot of discussions with our clients about what their objectives are and setting targets. And I think these are all really important things to do, because without that objective and that target, you're just kind of floating around. You don't have anything to specifically aim for. And I've seen some studies that basically say that even if you aim for your number, now let's just pretend your number is $3 million, say, outside your home and what have you. Even if you aim for $3 million and you miss it by a bit and you get to 2.8, you've probably done much better than what you would have if you didn't have that objective or that target to begin with. So I think the power of targets is actually a really important thing. So it then comes down to that if you are planning to retire before age 60, keeping in mind that that is when you may be able to get access to your super. Now, that's what the rules are now. For the younger demographic, it might be by the time they get to age 60 that that age might have pushed to age 65. That is a complete possibility. So it's about building in some buffer zones or some strategic planning on what do we do for that gap between call it the 55 and the 60, or the 55 to 65. And what do we do with that time where we're not going to be able to have access to our super? We may not be able to work, or we may not want to be working. So what happens in the middle of that age bracket? So this is probably where, rather than focusing on their total wealth, and once again, just using the example of $3 million as a target, what we want to do is actually say, okay, well, the majority of that we do want to have in super, because super is going to be where you're going to spend the majority of your retirement years. Call it 20, 30 years. You'd like to think that it's going to be. And particularly for self-funded retirees, that's very normal nowadays.
Absolutely.
So we're now looking at, well, what do we do for the 5 or 10 years that we want to save for? So that number might be anywhere from $500,000 to $800,000 that we want to set aside or have as our target for those pre-retirement years. That, when I say pre-retirement, pre-superannuation access years. So what it then comes down to is, okay, well, I've got a target of 3 mil. I then have a sub-target of, call it $500,000 or $800,000 of that 3 mil. We want to be able to have outside of superannuation where it can be more accessible if we need or want it to be. So that's kind of where we start.
So you're sort of putting a foot in each camp, and I guess, to use that old idiom, you know, if you fail to plan, you plan to fail. So this is really about setting out some I guess some ground rules of, and I think it's really important, Michelle, and because you are a licensed registered financial planner as well as a CA, the last 10 years before you retire are pretty well, in my view, and I think the numbers, you know, an actuary would sit there and would say this is true as well. They're the most important years for you to get the platform right, to do the numbers correctly. And so this 5 to 10 years before you decide to pull the pin and either semi or fully retire becomes quite vital, isn't it?
Oh, absolutely. And the other thing is that it tends to be, if you look at your, I'll call it your productiveness in the community and in the work zone, you tend to be earning the most money between in your mid 40s to your mid 50s, because you're the most productive, you've got the most knowledge and wisdom, you'd like to think that you're most senior. You also, in most, fingers crossed, you'd like to think, but you've also, at those age groups, you've quite often, you've had your kids, and in a lot of instances, it's not always the case, but your kids are either off your hands or you can see the You can see the end of school fees and all the costs associated with kids that, can be very draining. So you're kind of in that zone where you then can really put the afterburners on in relation to your savings strategies and starting to really build your wealth, whereas it may have previously been towards paying the home loan off and funding your kids' educations or, their lifestyles and your family lifestyle. So it's really an interesting time zone to focus on and be very strategic in setting targets. And then, and this is the next thing we're going to start to talk about is, well, what are the tax structures that we should be thinking about in whose name should this be in? We can talk about super till the cows come home, but what we're talking about now is what do we do with the non-super elements? Should it be in his name? Should it be in her name? Do we use family trusts? Is a company a good way to go? These are the questions that need to be asked and answered as early in that process as possible, because to change your mind 5 years in can sometimes be quite costly. In that it's going to cost you capital gains tax, setting up structures, whatever.
We'll pick up on that in the second part, but I'm very keen to ask you, given that we've had law changes in the SMSF rules in the past couple of years where the number of people in the SMSF could grow, I think it was 2 up to 6. Have you seen people take advantage of that rule change yourself in day-to-day practice?
Have. We've had a number of clients that have had self-managed funds with very illiquid assets in them, so property, big properties. And as they're getting older, they want to actually try to keep that property, for example, in the superannuation environment, but they have all sorts of requirements on them in relation to taking minimum pensions. And
they need cash.
They need cash, and quite often the cash flow to pay their pension may not be enough. The rent that's being paid on that property might not be enough to pay the pension. So there's lots of complications there. This is where sometimes it can be beneficial, and once again, it depends very much on the family dynamic, I've got to say. Maybe adding the children into the superannuation fund provides some additional liquidity. It's got the potential to provide I'll call it the children, which at that point, they're certainly not children, they're very much adults in their own right, but it may actually provide them an opportunity to get some financial acumen and education and a bit of experience in a fairly light way, and just get them prepared for the fact that they're going to inherit these assets one day, and it gives them an opportunity to kind of put their toe in the water without, with floaties on, if that makes sense. So It can actually work. It can work well, but I also caution people to say that you've got to make sure that the family dynamic's going to be able to cope with that.
Oh, yeah. Well, look, we're just about half time here on Dollars and Making Sense. I'm Ray Treverson, and I have with me at the microphone today Michelle Griffiths from TAG Financial Services. We're talking matters to do with retirement, early retirement. And when we come back from the break, we're going to be talking about various tax structures and various vehicles that we should be using. So we're going to go for a short break and be back in just a moment. Hi, and thank you for listening to Dollars and Making Sense, a weekly radio program about finance, money and investing on Radio Northern Beaches and nationally on the Community Radio Network around Australia. The views, comments and opinions aired during our program should not be construed or viewed as financial advice. Any commentary is general advice only and does not take into account your objectives, financial situation or needs. You should consider whether the advice is suitable for you and your personal circumstances. If in doubt, you should contact an authorised licensed financial planner. We welcome questions and feedback, and you can get in touch with us via our blog, social media channels or email. Please search for Dollars and Making Sense in your favourite podcast platform or check out our blog at otgcapital.com.au/blog. Hi, and welcome back to Dollars and Making Sense, a weekly show about finance, money and investing. I'm your host, Ray Treverson, and with me at the microphone this week is Michelle Griffiths from TAG Financial Services. And just a reminder, ladies and gentlemen, Michelle is a licensed financial planner as well as a chartered accountant, one of these rare breeds. Oh, and I say she's female as well, because there aren't as many female financial planners out there as I think we desperately need to have, because this interesting facet of this life stage that we're talking about, just pre-60. I've mentioned Philippa Hunt before, and Philippa talks a lot about her clients that unfortunately at this very pivotal time in their lives end up going through some fairly horrendous marriage breakups, because when the kids finally fly the coop, they're saying, right, I've done my time, I'm really needing to check out. We're not going to cover that today because it's just, and I'm sure you've got clients in that space. We're going to focus very much so on the planning and the tax efficiency elements of being ready for this time. Now, in the briefing documents you sent through to me, and I think it might be worthwhile, Michelle, if you're okay, we might post a copy of this on our blog so that people can look at it. And again, it's a cursory aid memoir. It's certainly not financial advice, ladies and gentlemen. Everybody's different. And so it's simply a guide. But I think it's a really good segue, a really good starting point to have a discussion. So, Michelle, you mentioned a company structure and also family trust. So which one do you want to kick off first?
Well, let's talk first about what a family trust is, because I think that's probably a good place to start. Historically, a lot of people, and I'm thinking, I call it 10 plus years ago, a lot of people, if they went to their accountant and said, I'm starting to get some investments, they would have been recommended to go into a family trust. Now, the purpose of the family trust is that it's very flexible. The trustee is essentially, I'll call it the boss of the decisions associated with that trust. It can then go and invest in property, shares, managed funds, whatever you like. The benefit of the family trust is that the trustee also makes a decision as to who the profits every year get distributed to. Now, that can work really well if you've got one spouse that is earning, reasonable money, and therefore that's where the cash flow for the savings is coming from, and one spouse that's at a very low income, in which case you can just simply have that money channeling down to that lower income spouse. Doesn't work quite as well anymore for channeling it through to children, because number one, they have to be over 18 to really make the most of it. And number two is that the tax office are really onto the fact that if you distribute to the children, you've actually got to pay the cash to the children. So that kind of defeats the purpose of accumulating the money.
You mean I've actually got to give it to them?
I know.
Oh, my God.
You would think that everything that we paid all this time would have been sufficient, but no. So there's this added level of complexity that's been added probably only in the last sort of 3 to 5 years. The tax office will really become a little bit more fixated on the fact that it actually has to go to where the distribution has been for tax purposes sent. So that's a bit problematic for us. The other thing with family trusts is where you have a situation where you may have two partners in a relationship, or spouses if you like, who are both earning reasonable money, then where do you go? Because anything from the family trust has to be distributed somewhere. Historically, it's been down to either of the spouses. What has also been historically in the place is they may have set up a beneficiary company. So what they might have called a bucket company. So basically set up a company, you pay the distribution, or you send the distributions down to this company, and then they get parked in this company. The problem, once again, is the tax office now really want to see the cash flowing into that company structure. So all of these things have probably become more complicated with using the family trust structure over the last, I would say, 5 years.
So, Michelle, can I just ask a question of clarity then? When you say family trust, so you're talking mother, father, direct children, who else can be part of that family trust? And the ATO looks at that and says they are family.
Yeah, great question. So it's a pretty broad definition. Most trust deeds will define who the specified beneficiaries are, and in most instances that'll be mum and dad, let's call it. But then there'll be another set of beneficiaries called a general beneficiaries, and those general beneficiaries will be pretty much any family member of the primary beneficiaries and any other company or trust or entity directly associated with those specified beneficiaries. So if the specified beneficiaries, call it mum and dad, have got a company that they set up, that they control, it by default is a potential beneficiary of that trust.
But do they? But the beneficial owners of that company, for example, if they are not related to the family, but let's say they're minority beneficial holders, can they still potentially benefit from that family trust?
Potentially. I don't know why you'd
Wow.
want them to, but yeah,
No
potentially
doubt.
you
But
could.
I'm
Yeah.
thinking then in blended families. I'm thinking
Oh,
best
yes.
mates. I'm thinking, long-time friends. I'm also thinking LGBTQI kind of scenarios where, the nominating of family in that instance becomes problematic for a whole
Yep.
range of reasons I don't want to delve into today, as it's a finance program, not an agony aunts discussion. But I have very close friends that are in that community. And so from that perspective, it's not always black and white.
Oh, what
Shades of pink definitely come forward in no uncertain way.
shades of the rainbow. No,
Absolutely.
it's actually probably more about what the deed says, and most deeds will say something along the lines of mother, father, aunt, uncle, nephew, niece, children, grandchildren. Basically, they tend to name the family, I'll call it relationships that could be encompassed in there. But
Right.
there's always another definition, which is basically spouse. And this is probably where, if you've got the, same-sex couple, you're going to fall into that spousal definition in a lot of instances, and therefore it becomes then the relations of those people. So, it does come down to what the family trust deed says. And if you've got specific requirements, then you need to be thinking about that.
So if I was to paraphrase what you've just said, then in regards to company structures and family trust structures, what you're in essence doing is to look at, let's say, the high earning potential of maybe one or two or a number of individuals, and within a family environment, then I guess spread that out so that the marginal rates of tax, they all come up, I guess, that rising tide raises all the boats. And so they're all brought up to a certain level. So you are equalizing, I guess, a taxable income across multiple taxpayers. Is that what we're talking about?
That's pretty much what a family trust can do. Absolutely. The problem that we've got with family trusts is that they're not looked on very favourably by the tax office, let's just say. So there's lots of rules about what you can and can't do. And I've already mentioned some of these things about the distributions having to actually get paid down to the next, to the next level or whatever. So there's just been a lot more complication with it. I think land tax, there are penalties associated with holding property in a family trust, for example. So bottom line is what we are now looking at, and particularly where you have two individuals or the two spouses that are both on reasonable income already, keeping in mind that the company tax rate is 30%, or if you've got a base rate company, which basically is an operating business in a company, it could be as low as 25% now. What we're looking at now is the option of forget about beneficiary companies and bucket companies and what have you. How about we just have the company be the investment vehicle, but with the shares in that company owned by a family trust? So you still get the level of flexibility as far as where you want profits finally to go, but we can cap the tax rate at 30% whilst they're continuing to earn money because they're working. Then when they stop working, or even if one of the spouses stops working, we can then deliberately turn on a dividend stream from the investment company that goes out via the family trust, which means we can pick where that income finishes up so that we can get it into the right hands to, exactly as you say, spread out that marginal tax rate and use as much as we possibly can to get the tax rate down.
Now, again, a question of clarity. Let's say you've got a couple of trustees, usually mum and dad, and you've got a bunch of kids. It doesn't necessarily mean that they've got to divvy up this booty in equal shares. That it's up to their discretion, isn't it?
Correct. That's a really good question, because I've had a lot of questions from clients where they say, well, I want to be able to distribute to my kids, but I don't want to be in a position where I'm forced to. And that's a really key distinction, because it's the trustees who make the decisions every year as to where the distributions are placed, if you like. just because you are a general beneficiary or you are a potential beneficiary doesn't give you any claim on that trust.
That's very important to realise then, because then you may have certain siblings that decide, I deserve, even though they may not, and mum and dad may step in and say, I'm under no obligation. And I guess that's, and again, I don't want to turn it into agony aunt, but I know from my discussions with Philippa, you end up having these discussions whether you like it or not, because particularly when there are estates at grabs, and there are very, very valuable homes now coming up for grabs in estate divvies, and so it becomes a real issue. Okay, so we don't have a lot of time left. Process. What's the first thing that people should be doing then if they're going to consider a family trust structure?
Whether it be a family trust or a company owned by a family trust, every situation is going to be different. So it really is key to be able to come and talk to someone who has got the accounting and tax knowledge. I mean, ideally, you've also got some investment background as well, because these decisions are a long-term play. If you go to your accountant that they're only looking at what is going to be best for you for the next 1 or 2 years, you are going to come unstuck. And unfortunately, when you go to a lot of accountants, that's their mindset. Our mindset is, what should we be doing now that is going to benefit you in 10, 15, 20 years' time? And how does it fit into the big picture of what we started talking about today, Ray, is what those targets are, what are we trying to achieve here? And then you backfill what is the best structure in your circumstances.
Excellent. Well, we're just about out of time, and it always ends up being so darn fast. Michelle, definitely got to have you back again. Twice is obviously not enough. Look, thanks for being on Dollars and Making Sense, a weekly show about finance, money and investing, Radio Northern Beaches and around the Community Radio Network. And don't forget, if you've got feedback or questions, ladies and gents, please feel free, get in touch with us. We're on socials, we've got channels, we've got email. We even have telephones, believe it or not, that people can pick up and actually dial and talk to a real person. We're on a blog. Michelle, I hope you'll put our stuff on your blog as well. And Michelle Griffiths from Tag Financial. So thank you so kindly for being on the show.
Talking to you, Ray.